วัสดีค่ะยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัทพีเชียชิปปิ้งจำกัดมหาชนนะคะหรือ PSL โดยคุณคานิดฮาชิมกรรมการผู้จัดการจากอัปเดตในเรื่องของภาพรวมของอุตสาหกรรมและตามด้วยคุณกอตัมคูรานากรรมการการเงินนะคะในเรื่องของผลประกอบการไตรมาส 3ที่ผ่านมาและในช่วงสุดท้ายในเรื่องของคำถามคำตอบเพราะฉะนั้นถ้าท่านใดมีคำถามให้สามารถพิมพ์เข้ามาในระบบได้เลยนะคะค่ะขอเชิญคุณคาริกค่ะ
Thank you, Son. So let's start with the presentation on the industry side. And here you can see clearly that China in the first 9 months of this year has really outshone everything that is available in the dry bulk market. So if you look at China's iron ore imports in the first 9 months, it was up by 4.8%. If you look at China's coal imports, it was up by 12% and likely heading for a 500 million metric ton number by the end of the year. China's steel production was down by 3.8%. The average steel inventory is the same. There's no change since last year in the 9 months. Steel imports were down by 9%, but remember, this is a very small number. Makes no difference. It's 5.2 million metric tons versus 5.7 million metric tons. Steel exports, of course, on the other hand, was massively up by almost 20%. And if you look at last year, it was already up by 32%. So it's really growing at a good pace. Steel consumption in the 9 months, of course, was down by 6%. If you look at the average of the last 5 years, that is 2018 to 2022, both years inclusive, you will see that the average steel consumption per annum was 953 million metric tons. Compared to that in 2023, the consumption level was at 971 million metric tons or plus 2%. So steel consumption is growing rather than falling if you compare it with the last 5 years. So despite the slowdown in the property sector, what has China done to make steel consumption get the least amount of an impact? And if you see that, you'll see that the government has focused on alternatives for steel consumption, like infrastructure and manufacturing. If you look at steel exports, as I said, it grew by 32% in 2023, and now it's grown by another 20% in the first 9 months of this year. If you look at steel exports from China in January to September, it rose to an 8-year high. If you look at the electrical cars and ship construction, is doing really well, and it is supporting steel consumption. Just by the way, China is today almost 70% of the entire shipbuilding market. If you look at Q1 for this year, normally Q1 is a very weak quarter. It was much stronger than anticipated. And therefore, if you look at the seasonality for this year, there is not much of seasonality at all. If you look at the Pacific market, thanks to China's very strong imports and exports, it has benefited hugely the handy-size Supramax and Ultramax sector of the market, which is where pressure shipping is located. If you look at the data that Clarkson gives you on what is driving imports into China, since 2020, it has been driven more by the price of commodities rather than by a requirement of commodities. So, for example, if you look at 2020, imports were up 9% because low prices were there of commodities as the rest of the world shut down during COVID. In 2022, volumes slumped. Why? Because of the Russia-Ukraine war, which made commodity prices soar. As commodity prices went up, China stopped importing or slowed down their imports dramatically. As prices dropped by almost 20% between September 23 and September 24, imports hit a record 4.6 billion metric tons in 2023. If you look at imports to China, they've reached US dollars 222 billion in September 2024, and it's up 2% month on month, up 0.3% year on year. So the trend of low commodity prices and high imports into China continues. Iron ore imports in October 24 is likely to reach 120 million metric tons. If it does that, it'll be an absolute all-time record. So the past all-time record has been 112.7 million metric tons in July 2020. If you look at steel exports in September 2024, it was up at 10.2 million metric tons for the month. So it's up 7.4% month on month, up 26% year on year, taking year-to-date exports to 81 million metric tons or 20% above year on year. So strong growth means demand is picking up in the rest of the world for steel commodity. And China is expected to end 2024 with a growth of over 20% in exports at around 110 million metric tons against 90 million metric tons in 2023. But then if you look at the overall trade in dry bulk in billion ton miles, you can see that in 2024, it's expected to be 4.41%. Against that, there will be a growth overall in the dry bulk fleet of 3.2%. If you look at the prospects for 2025, it's going to be 0.68% in terms of the change in trade. It's going to grow by 0.68%. And against that, you have a change expected in the dry bulk fleet of about 2.9%. If you just look at minor bulks and look at their ton mile growth in billions of ton miles, and if you look at the percentage growth, you can see that in 2024, minor bulks are going to grow by about 3.6%, and in 2025, it's going to grow by 2.4%. Against that, the change in the ships, that is the net increase in ships in the geared sector will be 4.3% for 2024 and 4.2% in 2025. But please don't get alarmed by these figures. As you can see over here, growth of trade in 2024 as forecast by Clarksons has changed quite significantly from the time they started out in January 2023, saying it will be 2.02% overall trade and 2.82% increase in minor bulks. And now finally in October of this year, they are forecasting 4.41% increase overall in trade and a 3.59% increase in the minor bulk trade. So again, Clarksons, with all their resources at their command, are not able to forecast with any clarity, really, what is going to happen in any 1 year in terms of ton-mile trade demand growth. Similarly, if you look at the fleet growth, if you look at the January edition for 2023, forecasting fleet growth for 2024, Clarksons had overall fleet growth of 0.3%, and with the geared ships growing at 0.6%. And by the October 24 edition for the same year, they're showing an overall growth rate of 3.2%, with the smaller ships or the geared ships growing by 4.3%. So again, as I said, Clarksons are not able to forecast neither the demand side nor the supply side with any real clarity. So coming to 2025, it seems that the predictions made in January 2024 have now shrunk down from 1.58% on the overall ton-mile growth for dry bulk to 0.68% in their October edition from the January edition. And if you look at the minor bulk, it has grown, or rather it has shrunk from 3.22% to 2.39% in the October edition. Similarly, if you look at fleet growth in the January 24 edition for 2025, overall fleet growth was supposed to be at 1.1%, with geared ships growing at 1.8%. Instead of that, you see that in the October edition, the overall growth in the fleet is pegged at 2.9%, with the geared ships growing at 4.2%. Coming to commodities and how they are distributed or carried by the various size sectors in dry bulk, you can see, for example, for Capes, they spend 74% of their time carrying iron ore, 16% on coal, and 10% on minor bulk. And that minor bulk consists mainly of bauxite from Guinea. If you then look at the Supramax and Handysize, you see that our concentration is in minor bulks. 59% of minor bulks is Supramaxes carry 59% of minor bulk, or in terms of time used on it, and Handysizes are spending 63% of their time on carrying minor bulks. So for us, minor bulks are more important. And if you look at the overall fleet growth in the first 9 months of this year, you see the following. First of all, that there are 14,074 ships in the world fleet. The average age of the world fleet is 12.21. But if you look internally and look at the geared ships have an average age of 12.58 years, and the younger fleet is at 11.74 years, is at the Panamax and Capesize sector. If you then look at the total deadweight, it's crossed 1 billion tons mark. And if you look at the average deadweight per ship, it's almost at 73,000 tons. If you look at the growth in the last 9 months, you would see that in the 9 months for 2024, geared ships have grown by 12.78 billion metric tons. And for the gearless ships, they've grown by 12.81 billion deadweight tons. So you can see more or less it is all at the same level. They're growing at roughly the same speed. If you then come to the next slide and look at the total order book, it's at 98.66 million deadweight tons, which is 9.65% of the existing fleet. And if you compare that with the 20-year-old fleet as of today, as of the 1st of October, it is at 9.45%. So not too much growth in the order book to fleet ratio compared to the 20-year-olds in the fleet. What is interesting in this slide, of course, is that in 2009, the order book to fleet ratio had reached a gigantic 78%. If we then compare the various periods of time, 2003 to 2009 as the boom years, 2010 to 2020 as the very low years, then 2021 and 2022 as a mini boom, and 2023 as a bad year, and then the 9 months of 2024. So if you look at that and look at, say, for example, the annual average demand in billion ton miles, in the first column, you can see it was growing at 5.5% per annum. In the second column, you can see it has dropped quite sharply to just 4.3% per annum. And in 21-22, it has dropped to just an average of just 1.5%. And if you look at 2023, it grew by 4.7%. So a very good year in terms of ton-mile demand growth was there for 2023. And in the 9 months of 2024, we are estimating by Clarkson's that for this year, it will grow by 4.41. If you look at the speeds, on the other hand, speed has dropped from 13.5 knots down to 10.9 knots in 2024. So it has dropped almost by 2.5 knots. Keep in mind that every time the world fleet drops 1 knot of speed, it means that the supply side is shrinking by 5.5%, so long as the ships sail at sea for maximum 250 days. If it goes beyond that 250 days in a year for sailing time, then the percentage of the fleet being removed because of the slowing down of speed will become even larger. If you then look at the growth rate of net supply at the start of each of these years in this chart that we have, so in the first period of time, it was growing by 6.8%. So very healthy fleet growth during the first 7 years of this period that we're looking at. And then in the next 11 years, it was growing by 6.4% per annum. So again, a very strong growth for a very sustained period of time. Then you look at 2021 and 2022, growth rates have gone down to below trend at 3.3%. And for 2023, growing at 3.1%. And for this year, it'll expected to grow by 3.2%. Now, the interesting part is, again, as I said, that even in 2024, at the start of the 4th quarter, the average forward fleet ratio for forward book of forward ordering of fleet compared to the existing fleet was at 9.65% against an old age or a 20+ year fleet of 9.45%. So effectively, supply for the next few years should be relatively benign. This just gives you the same chart, but showing it in a separate format for the various periods of time in terms of the speed. This gives you the congestion in each of these years. And you can now look at 2021 and 2022, and you will get a feeling that because of high congestion in these 2 years, we did very well in terms of the earnings per day per ship. And if you look at our profitability, if you look at 2021, we made $137 million net profit for that year. If you look at 2022, we made $139 million net profit. And then if you look at 2023, you see that congestion is starting to ease off. And in 2024, that easing off has been, once again, looks like it's coming back. If you look at 2023, despite the very strong growth in ton-mile demand of 4.7%, as against a fleet increase of only 3.2%, we still did quite poorly in that sense when compared to 21 and 22, because we only made $20 million net profit in that year. Right now, if you look at our net profit and just extrapolated basis, 1 quarter additional, just an arithmetic extrapolation, we should be at more than double the level of profitability for 2023. If you look at this chart, it shows you how the BDI has changed in the 9 months in 2024 compared to 2023. It was up by 58%. If you look at and compare it with 2022, it is down by 11%. And compared with 2021, it is down by 33%. So you can see from the BDI that 2021 and 2022 were definitely very good years. And 2024 is a reasonable year in comparison to them. And if you compare it with 2023, then you can understand why 2023 was a poor year. As I said, because of a reduction in congestion. And despite the increase in demand, we still had a reasonably poor year. Many owners in 2023 made a loss, but we were profitable even in that year, as I said, by $20 million. Coming to the order book, if you look at the order book, in the first 9 months of this year, we've ordered 33.51 million deadweight tons of ships, and compare that with the order book of the first 9 months of 2023, we were down by 10.3% compared to that. But compared to 2022, we were up by 20.7%. But compared to 2021, we were down by 24.3%. So again, it shows you that not much of ordering has taken place, despite the fact that we had 2 fantastic years in 21 and 22, a reasonable year in profitability, at least for PSL in 2023, and a much more reasonable year so far as it looks like in 2024. Now, the reasons for that are, as shown here, basically we got crowded out. We were a little late to the ship ordering party, and therefore did not get slots for ship until 2027 at the earliest. Shipyard capacity is still down by about 40%. And the main reason, I think, is that people are worried about having a stranded asset by ordering fuel oil burning ships. Main engine availability is also a very big constraint, as the main engine manufacturers have not increased capacity as compared to what the shipyards are doing. So again, this might delay the forward order book, even though it's showing as quite high per annum in terms of where we were. It might be much lower because, as I said, that the main engines are not necessarily available. Coming to a summary of the industry position, the IMF says that world growth will be at 3.2% in 2024 and a similar growth rate in 2025 of 3.2%. IMF and the Chinese government are forecasting China's GDP growth rate at 5% in 2024 And so far in Q1, Q2, and Q3, the GDP growth rate has stood at 5.3%, 4.7%, and 4.6%, respectively. If you look at it in ton-mile demand growth of 4.74% in 2023, it was driven by China's economic recovery. Steel consumption in China was marginally negative in 2023, but it was ably supported by shipyards, electrical car makers, infrastructure development, and lots of steel exports. If you look at the fixed asset investment in 2023, it was up by 3%, and in the first 9 months of 2024, it's up by 3.4%. If you look at the fleet growth, it grew by 3.1% in 2023 and is forecasted to grow steadily by 3.2% in 2024. Net supply will be further reduced due to lower speeds, compliance with EEXI. EEXI helps you to reduce your CO2 output, but there are no penalties, and therefore people may not take it too seriously. The forward order book to fleet ratio at 9.65% on the 1st of October is marginally higher than the existing 20-year-old fleet at 9.45. Keep in mind that the order book is spread all the way to 2027. And if we were to extrapolate this 9.45% of 20-year-olds and look at it, what it would be like if there was no scrapping at all in 2027, then it would have grown by 15.43%. So if you're comparing like for like, then you should compare 9.65% of the fleet ratio versus 15.4% of ships that are older than 20 years of age. Of course, then there are lots of disruptions. This was also what helped a lot during 2021 and 2022 in terms of the Panama Canal being with having low water, Suez Canal being disrupted by the Houthi bombing, congestion at South and North American grain ports, climate change, extreme weather events resulting in disruptions at sea, increasing ton-mile demand, and delays at port also. And all this has helped to push up rates. Supply and demand balance continues to improve. Now, this is what I want you to focus on. This is what is known as EPL, or engine power limit. It's been applied to 21 of our ships. And if you look at the engine power limits applied to our 21 ships, you can see that the average for the 21 vessels, the speed before EPL was 14 knots. Post EPL, it has dropped to 12.5 knots. That means there is a drop of 1.5 knots. Now, keep in mind that every 1 knot reduction in speed of the entire world fleet would equal to 5.5% supply reduction based on 250 days at sea. Now, if you apply the EPL that was applied to our ships and use that as a benchmark for the world fleet, remember the world fleet is older than our fleet. Our fleet is roughly 12 years old. The world fleet is almost 12.6 years old. But if we apply this same formula that we have for our fleet and apply it to the world fleet, then you would see that the supply side will decrease by 5.14% based on non-eco engine ships and 250 days at sea. Coming to the ships that were not affected, you can see these are the ships that are not affected, and the average speed of the 15 ships would be 13.3 knots. So what has been our strategy so far, considering the industry scenario and our fleet? So you can see that we were at 36 ships in 2021 and had been there like that at 36 ships for quite a while. Then in 2022, we added 2 more ships, so we became 38 ships, maintained the same strength in 2023, and up to the first 9 months of this year, it has also been maintained at 38 ships. And now, in the month of October, we have taken delivery of 2 more ships, and so we are now at 40 ships. If you look at the ships that we sold Ratnanari, Vishandanari, and Charananari. If you look at them, one was 22 years old, one was 11 years old, one was 19 years old. If you look at their speeds at 12 knots and see what was their consumption at that speed, then you can see that the first ship, Ratnanari, was consuming 18 tons, Vikantanari was consuming 26 tons, and Charananari was consuming 17 tons. Now look at the ships that we bought as replacement for these 3 ships that we sold. So far we have taken delivery of 5 of these ships. We have 1 more ship to go, which is expected by the end of this month or early next month. If you look at the speeds of these ships at 12 knots, what do you see? The consumption at 13 tons, 16 tons, 16 tons, 17 tons, and 16 tons. So you can see we are buying very good quality eco-engine ships compared to what we're selling off, which are non-eco-engine ships, consuming much higher quantities of fuel. And then we have still 1 more ship to be to deliver, as I said, before the end of this month, or maybe at the early part of next month. All these ships are approximately 40,000 deadweight, just shy of 40,000 deadweight. Now, if you look at what has been our market position compared to the existing index ships, the index ship for the handy size is at 38,000 tons, and our ships average 32,000 tons. So you can see that we are at quite a big discount. I would say about a 20-25% discount compared to the index ship, if you take into account the fuel consumption as well as the size reduction that we have. And then if you compare that, you would see that we actually fared we were down by 10.38% compared to the index ships. If you then come to Supramax and look at the index ship and look at our ships, we have performed at 5% below the index ship. If you look at our forward order book for this year, 2024, we've already pre-booked 6,234 days out of a total of 13,705 days at an average price of $14,446. So if you multiply the average price by the total number of days pre-booked, you will get 90.1 million. Similarly, if you look at next year, this number of 45% drops to 26% and 3,660 days. Against that, we've got a time charter rate of $15,653 per day per ship, which would give us $57 million. Similarly, if you look at 2026, we have got 14% pre-booked at 14,673, and that will give us $28 million total pre-booked income. And then for 2027, we've got 13% pre-booked, 1,765 days at 14,611. So now Gautam will take you through the financials.
Thank you, Khalid. These are the highlights in Q3. For the quarter, we reported a net profit of about 279.9 million, or USD 8.23 million, or 18 satang per share. We had an EBITDA of 682.7 million, or USD 20.48 million. We paid our second dividend for the year 2024. This was 10 satang, and this was paid on 6th of September 2024. We had a very active financing period during the third quarter. So on 22nd of August, as you can see, we signed a loan agreement with Sinopac of Hong Kong in the amount of 18 million. We also entered into another facility with Exim Bank of Thailand, 13.58 million. And then in the fourth quarter, in the beginning of October, we entered into 2 credit facilities. First was a USD 13.5 million loan with Yo Bank, Japanese bank out of Singapore. And then we also issued the first sustainability-linked bond issued by any Asian shipping company. So there were 2 series. There was a 5-year tranche, and there was a 10-year tranche. And total amount that we raised was about 1360 million. That's about 40 million US. We acquired a number of ships, as we talked about. And then we have, in terms of long-term charters, we continue to have 5 ships that are on very, very long-term time charter contracts at fixed rates. And then we have 17 ships on long-term time charters at index-linked rates. So here's a summary of the acquisition and disposal of vessels. So I think Khalid has already covered most of this. Perhaps I can just add as far as the new buildings are concerned. So we have ordered 4 Ultramax new buildings, and these are scheduled to be delivered in 2026. we are scheduled to take delivery of another 6th second-hand handy-size vessel, probably later this month or early next month. So key figures in Q3. So total revenues of $42.8 million US. This was down from $47.2 million in second quarter. Net profit was $8.2 million, down from $14.4 million in the previous quarter. The earnings per share came in at 18 satang compared to 34 satang in the previous quarter. Return on equity was slightly down, 8.1% compared to 8.59%. And net debt to equity ratio, this went up a little bit because, of course, since we've been acquiring ships, it's still at a very low level from a historical perspective. It's at 0.32 compared to 0.26. And the number of ships that we have on our fleet is 38 versus 36 at the end of the second quarter. So this, on the top left, we show you the time charter, the average time charter rate per day in dollars for all the ships in our fleet. And you'll see that the latest quarter, the third quarter, average time charter rate was the second best of the last 5 quarters. It came in at, the average rate was 12,755. The EBITDA was quite healthy. It was 20 million. Over here on the bottom left, we show you the dividends, and we have paid out dividends of about 155 million in the third quarter. And we have quite a healthy cash balance. We ended the quarter with 49 million US. So this is a picture of our balance sheet. So you'll see that at the end of the third quarter, we have 626 million of vessels and equipment. Our shareholders' equity went up to 494 million compared to 475. Cash, so we use some cash to partially pay for some of the ships that we've acquired, and so you see that some of that vessels and equipment has increased and cash has gone down. And overall debt has actually declined a bit. So it was 214 million at the end of last year, and that's down to 205 million. So here again is a summary of the cash movement in Q3. So we ended the second quarter with 75 million of cash. We generated 28 million of cash from operations. We of course acquired ships in the second-hand ships during the quarter. So that's 48 million of cash went towards capex, 4 million towards interest cost. We also drew down a loan, so that was 18 million, and we partially prepaid another loan. In addition to repayments, so that was 16 million, and we paid dividends of 4 million, and we ended the quarter with 49 million. So this is a summary of loan movements from during the quarter, or actually since the beginning of this year. So 214 million is what we started out with. We drew down 50 million from several banks. We repaid 22 million. We prepaid 37 million, and we ended the quarter with 205 million. And we still have a number of undrawn loan facilities available. So we've got 88 million of undrawn facilities available from IFC, CASEP, and EXIM, and another 2 large facilities from EXIM, which we can draw down. In addition, so I think we already covered Yobank, yeah. So here's a summary of our operating expenses. So you'll see that the total operating expenses in the third quarter, they came in actually slightly lower than the total operating expenses for the second quarter, but of course the differences are quite marginal. In general, we would say that costs have remained fairly stable. That's what's reflected over here. So this over here, we show you on the left, the lighter column is the average industry operating expenses, and the darker column shows you our operating expenses. So as you can see, we are still lower than the average industry operating expense. Every $100 in savings translates to about $1 million on the bottom line at the end of the year. Over here, we compare our OPEX and G&A to other listed peers who own Supramax and Ultramax vessels. So as far as OPEX and G&A is concerned, so we are in total for these two items, we are the second lowest among our industry listed peers. In terms of G&A, we are actually the lowest. And over here, we show you the long-term last 12 months EBITDA per ship. And so we've come in at third, but it's almost second, I would say. Our average EBITDA per ship for the last 12 months came in at 2.66 million versus one of the other peers who had 3.26 million, which was the highest. So this over here, we show you the debt maturity profile. And so we've been very active in refinancing much of our debt, pushing out maturities. As you know, we also raised the bond, and that will also help in pushing out the maturity, the average maturity of our loans. And that's reflected over here. We don't really have very lumpy amounts due, very high maturities due in the coming years. It's very manageable amounts that are due. Over here, we show you the net debt and net debt to equity ratio. So you'll see that we peaked in 2017 when we took delivery of the final vessel that we had, final vessel in a series of vessels that we had ordered from several yards in China. Since then, we've been paying down debt, and we've come to a very, very low level, about 0.3. And of course, we have now started to acquire some second-hand vessels, and we've raised a little bit of debt to acquire these vessels. But still, it's the total debt, or the net debt rather, is still at a very healthy level of 156 million. So this over here, if you look at the top line, this is the average age of ships that we have in our fleets, and you'll see that from the year 2005 until about 2011, we had a very elderly fleet and also quite a small fleet. Thereafter, we embarked on a program to acquire new ships. We ordered new ships, larger ships, and so the average age of ships in our fleet came down, and also the average size of ships in our fleet went up, and at the moment is about 44,000 deadweight. This line over here shows you the average time charter rate per ship per day, and as you can see, 2005 until about 2008 was a very, very buoyant period. This is when China joined the WTO. But of course, this also coincided with the time that the order book was about 80% of the existing fleet. All the ships were delivered in the period from about 2008 until 2015-16, and that put a lot of pressure on rates, and that's why you see rates declining. Supply pressures abated significantly from 2016 onwards, and thereafter, which is why you see a gradual increase in rates because of better supply and demand fundamentals. Bottom line over here shows you the average operating expenses for the ships in our fleet, which has remained quite stable. Here we show you the dividends. So our policy is to pay not less than 25% of net profit to shareholders as dividend. We've generally paid more than that, as you can see. So there was a period from 2014 until 21. Shipping was going through a major downturn, so we stopped paying dividends, but of course we resumed it, and we are paying in general dividends that are at a level which is higher than the dividends, the minimum policy that we have. So here's a lot of data. I will leave that as a reference slide. Just one thing to highlight. So this is the total return to shareholders from our IPO in 1993 until about 30th of October. So you'll see that. So if you were an investor in our IPO in 1993 and you remained invested and also you reinvested all your dividends back into our stock, you would have earned a 15.76% IRR on your investment. So similar data points over here. This is data from a Splash 24/7 article on dry bulk listed companies. So you'll see that most dry bulk companies, listed dry bulk companies, unlike us, have actually not delivered positive returns for shareholders. Okay, with that, I think we are running out of time, so I will open up for. Okay, just one thing to just mention. So during the quarter, we received the Outstanding Climate Action Leading Organization Awards. This is actually the second year in a row that we received this from the government of Thailand. So we were also awarded carbon neutral certification by the Thailand greenhouse gas management organizations. This is for the year 2023. We already had it for 2022. We got this award because we offset completely our scope 1 and scope 2 emissions. And yeah, I think we can, since we're out of time, let's take questions.
So the first question is, I think, Gautam, you can answer, what is the average borrowing cost of loans?
So the average borrowing cost of loans, so let me answer it this way. So about a quarter of our debt is fixed rate, and this is fixed rate at, this was fixed when interest rates were extremely low, and about 75% is floating. So that's SOFR plus margin. Now we don't typically disclose the margins that we pay to our banks, but I think you can work that out yourselves by looking at the interest cost. You can figure out. So essentially it's a SOFR plus a margin, and that keeps changing. I mean, just now with the bond that we issued, that was issued at a relatively low level, so that should help in decreasing our overall interest cost.
Okay, coming to the next question, which regions are the most sailing routes of the PSL fleet in 2024? We don't have any regions or routes. We are like a taxi service. We perform the journey according to what the client wants. So no two journeys are ever identical, and no 2 years are ever identical. Then coming to the total of ships under long-term contracts, yes, of those, 6 of them are on, five of them are on long-term fixed rate contracts, and the balance are on long-term contracts which are linked to the index. Now, index link works like this. For the past 15 days, what is the average price per day per ship for the index ship will be what we will earn in the next 15 days. So we will get the prepayment of that on the end of, so like on day 1, we will be paid what was the average price for the last 15 days. We will be paid for the next 15 days at that average price. Coming to the revenue contribution on long-term
charters, maybe I can answer that. So roughly about 55% of our revenues comes from long-term charters. So that's fixed rate and floating rate, and that's about 45% of the overall sailing days.
Next question is, what are the strategies to mitigate the geopolitical risks between China and the US? Literally, we can do nothing. It depends on what China and US do. But what we can do is to make sure that our ships are able to carry the cargoes that are non-sanctioned or non-tariffed by the various governments. And we do that quite well. Coming to the next question. What could a second Trump presidency mean for shipping? Luckily for you guys, I just answered it to the press. The press had asked me the same question. So I'll just read out to you what my answer was. First point is the war in Ukraine will come to an end very quickly. Second, sanctions against Russia will be lifted and removed quickly. Oil prices will fall. It could fall very sharply depending on how quickly the sanctions against Russia are lifted. Fourth point, trade flows out of the Black Sea will increase immediately, and that will include grain, iron ore, and steels. Again, all carried by dry bulk ships, once a peace settlement has been agreed. Tariffs against China will increase, but let me tell you that in the 8 years since Trump started this tariff war, the number of containers coming into Los Angeles and Long Beach, which are the 2 major container ports in America, has gone up dramatically. So it's not that tariffs have had any impact on container flows into America. The Middle East will remain a war-infested area. This could change if Trump were to give tough love to his good friend Bibi Netanyahu. He has threatened to do that. So let's see what happens. In case there is peace, we would have a lot of redevelopment to be done in Palestine, because that has basically been bombed to smithereens. So we will have a lot of work to be done over there. In the Middle East, if the war remains and does not get resolved, then Red Sea will remain a no-go area, and therefore it will have a beneficial impact because ships will have to go via the longer route. The dollar will strengthen under Trump. Taxes on businesses will be reduced in America, and the US deficit will be out of control. That will result most likely in inflation and therefore maybe higher interest rates, and that will keep the dollar at a very strong point. So those are the points that would happen if there's a second Trump presidency, which looks most likely now. Why did the BDI index drop in October sharply? It dropped because the Capesize sector lost a lot of cargoes. And the main reason for that was that the bauxite out of Guinea had a strike in the port, and therefore no ships could load from there. So since 10% of Capesize ships are doing just bauxite from Guinea, those 10% came back in the market, and therefore they helped to push the prices down. And that's the reason why the BDI dropped sharply. Remember, BDI is affected by the Capes the most. 40% of weightage is from the Capesize sector. What is the best situation of port congestion that brings the most benefits to PSL's revenue? Any congestion is helpful. More congestion is more helpful. That's it. And then the short-term contracts for both time charter and voyage charter linked to the freight rates index. See, as I said, 5 ships are on long-term charters at fixed prices, and the balance ships, I think 16 of them, are on index-linked charters. So the index-linked charters will fluctuate with the index either up or down, but the long-term charter will be will remain the same.
Yeah, and the freight rate index is calculated every 2 weeks. Question is whether it's daily calculation or a 3-month calculation. So it's every 2 weeks.
Yeah, every 2 weeks. So that's it. We've answered all the questions also, and I think we are out of time. So thank you so much for all the interesting questions and for being such a patient audience.
ขอบคุณค่ะที่ร่วมกันพูดคุยและส่งคำถามเข้ามานะคะเวลาหมดลงพอดีต้องขอบคุณทุกท่านค่ะสวัสดีค่ะ